So now we're going to use our more sophisticated ISLM model and our understanding of the financial markets to talk about what actually happened in the housing bubble that popped sort of at the end of 2006 into 2007, and the recession it caused and the financial crisis that it caused as well. So if we, want to really understand what happened, we have to think about, housing prices. So here is a graph that it's an index of housing prices, meaning that it's set to 100 in January 2000. And you can see that by January, January-ish, early 2006, it had increased to 220. So it had increased by 120%. Housing prices had more than doubled in 6 years. And so what happens when the price goes up? Well, we start building a whole lot of them because we want to make money selling them. And in order to do that, we need money. Well, in order to get money, we started making a lot of mortgage loans that were then packaged into mortgage-backed securities and sold to various investors. And so we had a lot of money coming into the housing market, and one of the reasons was these mortgage-backed securities, as we'll talk about, were divided up into risk levels or tranches. And the banks had convinced the ratings agencies, so people like Standard & Poor's, Moody's, Fitch, that the top level was very safe, AAA rated, almost like as safe as federal debt, right? Treasury bills and treasury bonds. And this was important because some institutional investors have a requirement that a certain portion of their investments have to be in AAA rated assets. And these AAA rated assets were actually paying a higher interest rate than other AAA rated assets. And so there was a lot of money coming in to the housing market and the mortgage market. And that was fueling this increase in housing prices. So in this lecture, I usually show some clips from The Big Short. I'm not going to do that, both because I'm not sure that YouTube would like it, but also because I frankly don't have the editing skills. But I recommend both the original book by Michael Lewis. In fact, I recommend any book by Michael Lewis, and the movie, which has a lot of stars, is a great movie. It's a fun watch. You wouldn't think, the housing bubble crash and financial crisis would make a good movie, but in fact it does. So we had really low interest rates in the 2000s, partially fueled by the Federal Reserve keeping interest rates low, partially fueled by the large amount of savings, what Ben Bernanke called a global savings glut. So that was one thing, which helped housing demand, because when interest rates are low, mortgages are cheap. You can build more of a house or buy more of a house for a lower monthly payment. And mortgage lenders were increasingly willing to make risky loans. And so not only subprime mortgages, but mortgages where they didn't even ask for real documentation about things like asset levels or income. And the reason is that they were just packaging up these mortgages and selling them off to investors, and these investors weren't really looking at what was in these mortgage-backed securities. As long as that rating was what they wanted and the interest rate was what they wanted, they were happy. And so this was obviously a bad idea, but this is what happened. When the price level started to decrease, right after early 2006, many mortgages were underwater. And what underwater means is that you owe more on the mortgage than the house is worth. And in some states, you can just walk away and say, okay, you can have the house and the mortgage, good luck. In some states, you can't, but you can still default on a mortgage, right? And really, the major penalty for defaulting on a mortgage is that you lose the house. But if it's underwater, then maybe you don't want that house. And so lenders were facing really large losses, and the risk model that these banks had used in order to figure out what the risk for these mortgage-backed securities was, it was really flawed because it basically made the assumption that a default in one area of the country would not impact a default on the other area of the country. And really the assumption behind that was that we couldn't have a national housing bubble. We had never had one before, so it couldn't happen. And that was, of course, wrong. So we've got all of these mortgage-backed securities. They probably underestimated the risk. They definitely underestimated the risk. They also had, you have an incentive to get these high returns. So they were highly leveraged. And they avoided the financial regulations with these so-called structured investment vehicles, which they kept off the books. I mean, like, it wasn't illegal, but it was stupid, and the regulators were stupid. But you had these things that were going to impact the balance sheet and the income statement, but they didn't show up in the balance sheet. And then, as we said, we had the securitization of the mortgage-backed securities, which basically allowed these mortgages to be bundled up together and then sold off in slices to investors. So we had these tranches, right? Senior securities had, the lowest risk, but the lowest return. Junior securities had, higher risk and higher return. It's one way of diversifying risk, but it meant that the banks didn't have a lot of incentive to really look at the risk, right? So traditionally, a bank making a mortgage would keep the mortgage in its balance sheet, right? It would own the mortgage and it would service the mortgage, meaning, you would pay the bank. The bank would say, thank you very much. Now, when you get a mortgage, it's packaged up, sold as part of a mortgage-backed security, and some other bank will actually service the mortgage and send the payments to the investors. So, and then we had this, this idea that mortgage-backed securities were diversifying the risk, which they were doing in some ways, but not in other ways. And obviously, the way that they didn't diversify the risk was the risk of a national housing bubble, and that actually happened, and so it all sort of fell apart. The other thing that was important was that a lot of these sort of shadow banks were relying on wholesale funding, which is very liquid, which means that it can disappear very quickly. So you can think of this as like the money market, where there's sort of short-term borrowing and lending for corporations that are just trying to cover their cash needs. And so like deposits, in the 1930s in banks, people could demand it back very quickly, and they could decide, oh no, I don't want to, have my money with you. And so these SIVs were entirely funded through wholesale funding, and basically when the risk sort of became apparent, that funding disappeared, and those SIVs were in serious trouble. So what happened? Well, you can see, that consumer confidence actually started to fall faster, and that probably makes sense because they were seeing the value of their homes fall. Business confidence fell as well. It reached a bottom sort of in 2009. This is about, the economy started recovering basically in the third quarter of 2009, so the bottom of the recession was like June 2009. But people just didn't want to buy, right? People didn't want to buy things. The unemployment rate was going up. Banks were really risk averse, and so we can think about how we would describe that in our ISLM model. But basically, we get a big shift to the left in our IS curve. So we have lower confidence, so consumer spending decreases. We have a big increase in the risk premium, so investment spending decreases. Both of those things shift our IS curve to the left. What are we going to do? We have to think about policy. And so the fiscal policy response, first we increased the federal depository insurance from $100,000 to $250,000. The idea being that we don't want people taking their money out of the banking system, so we want to make sure that they're confident in the banking system. The Fed then provided widespread liquidity to the financial system. They basically lent money to whoever needed it institutionally, right? They didn't lend money to you or me, but any company that needed money, they would lend money to. And they introduced the Troubled Asset Relief Program. So what were those troubled assets? Well, those were mostly the mortgage-backed securities. And so they started buying mortgage-backed securities from the banks. Just like they would buy treasury bills or treasury bonds in normal times. So they would pay for them with reserves. And that is really what led to the sharp increase in reserves. In terms of monetary and fiscal policy, the federal funds rate was dropped down to 0, and then they used unconventional monetary policy. And so unconventional monetary policy involved buying those other assets, what became known as quantitative easing, right? And so quantitative easing was basically buying mortgage-backed securities, treasury bonds, so longer-term treasury bonds, some other types of assets. And then the fiscal policy was the American Recovery and Reinvestment Act, which was passed, early on in the Obama administration, which basically was $780 billion split between tax cuts and spending increases, all designed to try to push that IS curve back to the right. So did it work? Well, it worked some, right? So if we think about what happened, our IS curve, we start here in A and say 2007. We go to B, and you can think of this as kind of, 2000 by 2009. And then the monetary and fiscal policies start working, and maybe we get to A prime. And so output is still lower than it was, and it took a long time to recover. We didn't really fully recover from the financial crisis until 2014 or 2015, depending on the sort of numbers you're looking at. And so we had this major recession, right? The policies probably saved us from another Great Depression level event, but they didn't save us from what's now become known as the Great Recession. So I'd say it's, maybe a grade of C for monetary and fiscal policy. One of the things that they did that I haven't mentioned was that they sort of bailed out the financial sector indirectly by bailing out AIG. And AIG was this big insurance company that was selling these policies basically, and if you watch The Big Short, you'll see, so that if someone defaulted on a bond, you would basically be able to collect, right? So it's like buying insurance on a bond, and companies started buying these for mortgage-backed securities and other collateralized debt obligations. They're called credit default swaps, when they started sensing the risk, right? And the problem is that AIG had no way to cover all of these credit default swaps. And so the U.S. government, the Fed, bailed out AIG, but they weren't trying to save AIG specifically. They were trying to save all of the companies that had bought these credit default swaps from AIG. So a lot of money went into it. And really I feel like it was a failure of regulation, right? We had this financial crisis in the 1930s. We had put in a whole bunch of financial regulations. We hadn't had another financial crisis until the savings and loan crisis in the 1980s, which was fairly muted compared to what we had in 2007 and 2008. And basically that happened because we got rid of all the financial regulations that we passed in the New Deal era. And so I think that's generally the moral of the story, is that financial markets need a lot of regulation because they have an incentive to increase risk in order to increase profit if they are not regulated.